An entrepreneur delivers a presentation to billionaire investors they call the best they've ever seen. Yet he walks out without securing a single dollar. The pitch tackles a surprisingly mundane problem. Statistically, single men do not wash their bed sheets nearly as often as they should. His solution is a product called Jack Sheets. They are engineered specifically for men, utilizing advanced anti-odor technology to stay clean for extended periods. The fabric is woven from breathable bamboo fiber and infused with silver. This combination actively fights bacteria, preventing the sheets from developing a smell even after months of use. By addressing a highly relatable, slightly humorous hygiene issue, the founder instantly captures the room's attention. He uses this universal pain point to set the stage for a memorable presentation. That founder is Wen Winnie. He grew up in St. Paul, Minnesota, and brings a relatable underdog energy to his business ventures. The idea for his company sparked during a trip to Iceland. Without access to a washing machine, his clothes quickly became unbearable to wear. That specific travel frustration drove him to research material sciences. He set out on a mission to engineer comfortable, laundry-free fabrics for everyday use. Many early-stage founders operate under a common misconception. They assume that if they have a highly engineered product and a compelling personal origin story, venture funding will naturally follow. Wen embodies this archetype perfectly. He builds an emotional, authentic narrative that completely disarms his potential investors, setting their expectations incredibly high. When it comes time to talk numbers, Wen asks for $212,000 in exchange for a 10% equity stake in his company. When asked why he chose that specific valuation, he explains that he has a tendency to stutter when trying to say 200,000, so he picked a number he could pronounce smoothly. The panel reacts immediately to his raw authenticity. He completely abandoned standard corporate jargon, earning genuine smiles and high praise from investors like Mark Cuban. Then he reveals his initial sales data. Through a Kickstarter campaign, Jack's Sheets raised over $350,000 from eager backers. The atmosphere in the room shifts toward an assumption of success. The combination of high consumer demand and the founder's extreme likability seems to align perfectly for an investment. Massive crowdfunding numbers paired with a charismatic founder create a powerful illusion. For early-stage startups, it projects a sense of unstoppable momentum that can mask underlying operational risks. The tone in the boardroom quickly pivots. The investors move past the charming origin story and begin to interrogate the company's unit economics. This diagram shows customer acquisition cost, marketing spend divided by new customers. Wen claims $33 in advertising acquires a customer spending $148. But investors know hype-driven Kickstarter metrics rarely translate to the open market. A massive surge in initial crowdfunding is an isolated event. Relying on early adopters lacks the foundation to sustain long-term, predictable business growth. The final flaw surfaces under questioning. Wen has zero proven post-campaign sales, and he is severely plagued by massive shipping and inventory delays that have kept his initial backers waiting. There is a vast difference between launching a product that goes viral once and building a highly structured business model capable of scaling infinitely. The deal rapidly collapses. Despite their clear personal affection for Wen, the investors analyze the operational risks and drop out of the negotiation one by one. The brutal reality sets in. The entrepreneur who delivered what one investor called the best pitch ever walks out of the room empty-handed. Despite this boardroom rejection, his broader apparel company, Herculean, survived. He eventually fulfilled his orders and continued to operate successfully outside the confines of television reality. Sophisticated investors will consistently walk away from an excellent product and a likable founder if the underlying operational math does not multiply properly. Startup success relies on two distinct pillars: the ability to win a room's respect and the ability to win a term sheet. Charisma and humor will get a founder's foot in the door. Ultimately, however, investors write checks based on scalable math. Between a compelling story and an investable business model lies a perilous gap. This is the exact space where most promising startups die. Founders must proactively bridge this gap. They have to prove that their financials, supply chains, and acquisition models are just as rigorously structured as their origin story. Storytelling opens the door, but undeniable unit economics close the deal. To learn how to structure your numbers and build a presentation that actually secures capital, check out our VC-ready pitch deck guide in the description below.